If you are in Canada and you want to invest in US stocks, you have CDRs. If you're in Europe or the UK, you guys have currency hedged ETFs. What are the main implications of using currency hedged ETFs or CDRs to invest in US stocks? Or should you just buy the US shares themselves and handle the currency risk yourself? Thank you for watching. My name is Chris, and this is Real Trading. I've been trading since 2018. If you guys are out there in Europe or in the UK or in Australia or New Zealand, this is not only for Canadians because I'm talking about hedging currency risk here. Towards the end of the video, I think you guys are going to have a very good increased understanding of if you should be thinking about hedging your own currency risk or letting these banks and institutions do it for you through these currency hedged or currency adjusted products. For example, I'm looking at Tesla stock currently, and the move from the low to the high between April and December of 2025 was about 132.83%. Now, if I go over to the CDR, which is a currency adjusted Canadian dollar version of Tesla stock, the move from the high to the low was only 128.47%. So what happened to that extra 4.36%? That's one of the mysteries that we need to solve when it comes to should you trade CDRs or not. Now, what the CDR is, it's actually a very, very convenient product. It allows Canadian investors to deposit Canadian funds directly with their brokerage, and they can get exposure to US stocks without having to worry about converting funds to US dollars and then trading on the US stock exchange. And they have CDRs for stocks in Europe as well now. These companies are responsible for managing the currency risk. So what they do is they provide this product that is currency hedged, currency adjusted. So it would be the same thing as if you just bought the stock in Canadian dollars if it happened to trade on a Canadian stock exchange. A CDR is if you hired a private chef to cook for you, to cook meals for you. You do not necessarily see the recipes that they're cooking. You don't see exactly what they're putting in the food, but you do see the finished product, and the finished product is probably really, really good. Going out and buying the stock yourself on the stock exchange and handling your own currency risk in your own portfolio would be like if you created the recipe yourself, or if you obtained the recipe, then you went out and obtained all the ingredients to cook the meal, and then you cook the meal yourself, and you know exactly what went into that. But one thing that I will say, which is my opinion, is that in 2026, while we're witnessing the rapid decline of software and a lot of other things, I personally don't trust anyone. Especially not banks or financial institutions, but hello. That's just my opinion. One thing that you also have to consider is the CDR itself, or the currency hedged ETF, is a product that is meant to maintain a certain value. But it does not mean that the institution issuing the product is trading or is long that specific product. They might be short the product instead. Here's a great example of what a CDR would do in terms of protecting you against currency risk. If Tesla's US stock rises 5%, so Tesla shares went up by 5% in US dollars, but the US dollar falls 2% against the Canadian dollar, an outright Tesla stock position may only net about 3% by the time you sell the shares and convert your US dollars back to Canadian dollars. Now, if you bought Tesla shares using a CDR, the CDR's hedge would aim to cover that 2% change in the dollar against the Canadian, and it would deliver a return closer to the 5% return in Canadian. Again, minus the management fees or other inefficiencies that you might have in that CDR's price. The opposite scenario would be this. If Tesla stock went up by 5%, but the Canadian dollar falls 2% against the US dollar, meaning the USD strengthened 2% relative to the Canadian dollar, an outright Tesla stock position might net closer to 7% by the time you sell the shares and convert the US dollars back to Canadian. Now, if you did this using a CDR, the CDR's hedge would aim to deliver a return closer to what the stock actually is, closer to a 5% return minus the management fees and other tracking errors that might happen. And of course, these numbers are theoretical examples and they could differ in real life circumstances. From a tax perspective here in Canada, CDRs are treated the same as if you owned shares of a foreign company, and the dividends are treated the same exact way from a tax perspective. Now, here are some considerations and just some general statements that you might ask yourself in regards to if you should or shouldn't trade a currency adjusted product like a CDR. The first general question is, do you care about having access to trading fractional shares? CDRs are built-in fractional shares of US companies, but the thing is most brokers now offer trading in fractional shares directly of those shares of the US equities. So there's really no benefit for the CDRs there. Another thing is if you care about market access around the clock, like being able to sell a stock share position, let's say in the middle of the night, then CDRs are definitely not for you because they trade on the Toronto Stock Exchange. US equities trade overnight, and you can sell your shares at 3 in the morning if you want to. The only thing is you cannot sell fractional share positions at 3 in the morning, at least with interactive brokers. A general question, do you have a long-term opinion on the exchange rate, the currency of the stock you're buying, compared to your home currency? Do you have an opinion on that exchange rate? If you do, then you might want to express that opinion. How much of that opinion do you want to express? In other words, how much exposure do you want to that foreign currency? Because you can control this. Next question would be, do you have a long-term plan regarding the future proceeds of your stock trade? For example, do you want to reinvest the funds, or do you plan to convert them back to your home currency to invest in something here? One thing that's good is that CDRs are a little bit simpler from an accounting standpoint. Since CDRs are denominated in your home currency, you report taxes in your home currency, so a lot of the complicated accounting or the bookkeeping stuff is already done for you. Whereas if you convert Canadian to US dollars, that on its own is a transaction, and the position between US dollar and Canadian in your account needs to be accounted for from a capital gains standpoint. And for every single transaction that you do on that stock, you also need to consider the fair market value of what your home currency was valued at compared to the currency that the stock is denominated in. If you have a good broker that has good reporting functionality like interactive brokers, most of this is done for you automatically when they submit the tax documents in February. If you like this video so far, consider subscribing and click the like button. If you click that like button, you're telling YouTube that other people are going to probably enjoy this video. This video contains valid information that somebody else can learn from. You can help somebody else learn something new today just by clicking that like button. I would really appreciate if you can do that. Second thing is, if you want to support me further, check out some of the links down below in the description. Like check out my stockbroker interactive brokers, which I've been using since 2019. I've got plenty of content on the channel explaining why I use them and how I use them. Let's get back to the video. Cheers. Now, these CDRs aren't magic. There is a cost to trade them. One of them is the public cost that they disclose, which is their 0.6 annual fee, which is their hedging fee. I'm really happy to be making this video right now because all the other videos I've seen on CDRs are all sponsored or by these people that just want to promote them. But the reality is, I don't care if you buy a CDR or not. I'm just some guy on YouTube giving you guys my opinion on trading because I've been in this industry for a while and I genuinely have an interest in trading and investing. So let's talk about all the risks with CDRs. The first one is going to be counterparty risk of the bank, CIBC or BMO, issuing these CDRs. There's lower counterparty risk if you own the stock outright. Of course, there's still some counterparty risk because you're buying shares of a foreign company and that company could go bankrupt. But with the CDR, you're involving another third party there. So if you're not a fan of Canadian banks, then CDRs are not for you. The next problem with CDRs is liquidity. They're harder to enter and exit at fair market value when the markets get more volatile. Let's go over to my screen and show that for a moment here. Over here, I've got a quote monitor and I'm looking at Apple stock, which today has traded 41.2 million shares. And the CDR for Apple stock on the Toronto Stock Exchange has only traded 273,000 shares. This date is delayed by 15 minutes, so maybe that number is a little bit higher. Not even a fraction of what the real volume on the stock is. And by the way, this 41.3 million shares is actually not the total volume that's been traded today because there's something called dark pools, which are trades that only get reported the next day on US stock exchanges. Look at Tesla stock is traded 43.5 million and the CDR is traded 402,000. Not even 500,000 shares. The spreads on the CDRs look to be pretty tight here, about 3 cents and about 2 cents in the case of Apple. And this is delayed data, so it's not super reliable. If Apple stock is trading shares every few seconds, as you can see here, this time in sales is going absolutely crazy, like you would expect on a high volume US stock. I would expect only maybe 1 or 2 trades at most every couple of seconds in this CDR. If you look at the chart between the stock itself and the CDR, you will at times notice some imperfections or some tracking problems where the CDR does not always contain the full price range traded on the day for the stock. Because there's less trading volume, it doesn't always catch every single price. So like I demonstrated, again, this is just one cherry-picked example. Apple from the low to the high, 71.15%, and then I go over to the CDR and it is 67.82%. Now, one of the risks that is very rarely talked about is the fact that when you buy a CDR or a currency hedged ETF, the ultimate purpose of that is so that you can retain the funds in your home currency. But while you're doing that, you're also subject to the currency risk of your home currency. So these institutions like to push the idea of protect yourself against foreign currency risk. What if your home currency is depreciating against the value of other currencies? So while you were buying that CDR, if you held that CDR for so many years and then your home currency depreciated against the value of other currencies that you might use for business or investing, then your home currency now has less buying power. Now, I know some of you guys are going to say, well, look, I'm not a Forex trader. I don't care what other currencies are doing. And that's fine. I completely understand what you're talking about. But there are some people that think about investing in foreign markets, buying foreign real estate, relocating their business to other countries. If you're thinking about some things like that, then using currency hedged ETFs may not be the right approach because you want to go out and directly invest in those currencies, stocks, and economies. You see what I mean? Let's talk about options trading. Now, these CDRs do have options, which means if you own a CDR for a US company, you can sell covered calls on those shares. Let's say I look at Tesla CDR here. I'm on my Interactive Brokers platform. The problem here, look, there's a big problem. There's almost no volume being transacted here. This is not tradable volume. What I mean by that is if it ever comes time that you have to close the position or make a modification to your position, and there happens to be a relatively wide bid offer spread, good luck. You're not going to get the price you want, and you may not even be able to get out of the trade. So if you want to do options trading, like selling covered calls against your shares that you own, you're definitely going to want to do that on the outright stock. Tesla stock. Look at the volume. Even on weeklies and quarterlies, which have a little bit less volume, you can see there's just thousands and thousands of contracts being traded. There's nice and tight bid offer spreads. They're being actively quoted here. When the numbers are flashing, it means these are quotes constantly being changed. A market maker is adjusting their quote because there's a change in the fair market value of the underlying asset, Tesla stock in this case. And because there's so many changes and there's so much volume going through, you can get a better price because there's more quotes. So let's say I go over to March, you can see there's just still thousands of contracts being traded here. Owning the stock itself has no management fee. The main risk is how the currency of the stock shifts against your home currency, if that's something that you're concerned with. The USD against the CAD has seen some large swings in the past, but it is by no means considered a volatile risk asset. It does not move as much as cryptocurrencies or as much as risk assets do. So for that reason, you have to make an honest decision with yourself and say, if you're going to invest in the US stock market, how much currency risk are you willing to undertake? And do you have a reason for having US dollars? Do you go to the US frequently? Because if you ever sell some shares, you might use the proceeds of that share sale. I want to let you guys know something, is that everybody's Forex trading at all times. Whenever you go to a foreign country, you in some way are exposed to what that currency is doing. You have to have some skin in the game into that currency. My opinion is that banks and financial institutions want to make things easier for people and more digestible so that they can increase their conversions and increase the money they make. They want to generate volume. And so they're creating these products as a shortcut way for people to gain exposure to those stocks. But the reality is they're doing all the dirty work on the back end. They're basically saying, okay, guys, we'll give you the convenience of owning these shares, but we're going to handle it our way. You have to deal with our terms and conditions. And the reality is they're trading the US dollar against the Canadian dollar themselves. They're hedging their own currency risk and expressing their own bias and market assumptions regarding the currencies. Go and look at their balance sheet because you will see things that you would have never known before. They might be long out of their ass on the US dollar or the euro while they're offering you currency hedged products. So the currency hedged products that they're offering you offer a certain return, but what they're doing on their own books has nothing to do with that. Let's talk about dividends. If you guys are enjoying this video, destroy the like button, please. Just tap it so lightly. Thank you for watching, okay? If you're an investor that uses Interactive Brokers, you guys have a big advantage because Interactive Brokers has very low cost or good value when it comes to converting currencies. So there's no crazy FX fees and you get to convert at the exact spot currency rate. They are pretty much a Forex broker too. Let's talk about dividends. So dividends from Canadian Depository Receipts are considered foreign dividends, not dividends from a Canadian company for tax purposes. That's why I said that. They tax dividends from Canadian companies at a lower rate compared to dividends coming from foreign companies. It's extremely exaggerated on the corporate side. When you buy a CDR, you're entitled to the dividends that the stock is paying. You get the dividend in Canadian dollars. The other thing to consider is dividends from US stocks are subject to a dividend withholding tax. If you're in Canada, this withholding tax is 15%. So if the stock pays a $1 dividend, you will get approximately 85 cents out of that dividend. The rest of it is a withholding tax and you don't get it back. One thing to know is that there's no withholding tax on dividends received in an RRSP or RRIF account. All other accounts, including all the other registered accounts like TFSA, RRSP, are subject to that 15% withholding tax on dividends you receive from US stocks. And of course, if it's a non-registered account like a plain old margin account, or a plain old cash account, you are subject to the 15% withholding tax as well. Have a look at this portfolio window in Interactive Brokers. I want to demonstrate to you some of the things that you can do in a margin account. So you can see we have a Canadian dollar cash balance, a euro cash balance, as well as a US dollar cash balance. But if you look at our US dollar cash balance, we're actually in the negative here at minus 93,000. It's a permission you have to enable in the account. I'm allowed to have a negative cash balance here because I've entered into a leveraged Forex position and I bought some Canadian dollars in exchange for US dollars. But if you went out into the US stock market and you bought a US stock, this is pretty much what will happen. If you funded your account originally in Canadian dollars, euros, British pounds, Australian dollars, New Zealand dollars, and then you went into the US stock market and you bought shares of a US company, your USD cash balance would have been zero because you didn't convert, right? And then it went from zero into the negative, like in this case right here. Now there's no problem with that. What's happening here is you're using the capability of the margin account to purchase the shares of the company, and you're using your home currency as the necessary collateral in the account. But the one thing you got to be aware of is that when you maintain short currency balances like this, which arise from purchasing stocks or assets denominated in the currency. So if I bought US stocks, my US cash balance will go negative if I didn't have US dollars. What you have to be aware of is the fact that there is an overnight interest rate charged on any negative currency balances. Now there's different ways to handle this. So let's say I went into the stock market and I bought some shares. Let's do like Tesla stock, for example. And I just came in here and I just bought, say, 100 shares. We're going to look at our cash balance go even further down. So I bought 80 and I bought 100. Look at the portfolio. Now our USD cash balance is down to minus 134,000, but our Canadian dollar balance and euro balance, these didn't change. Currently, this is what's going to happen in the account. With Interactive Brokers, they pay you interest on positive cash balances, and you have to pay interest if you have a negative cash balance. The interest rates are different whether it's a negative balance or a positive balance, but you can find that information on their webpage, and it's pretty close to whatever the central bank rates are, minus or plus a certain premium, of course. So what's going to happen here is you're going to pay a certain interest rate on this minus 134,000. You're going to collect a certain interest rate in Canadian dollars on this $453,000 Canadian dollar cash position. They're going to pay you interest on that. Ultimately, what's happening is your rate of return on the stock position is being impacted by what's going on over here. And this is where it is up to you as to how you want to handle this currency risk. But what's happening here, because we didn't convert funds to USD, we have limited currency risk. We're not exposed to the currency exchange rate of our home currency compared to the US dollar because we didn't go in and buy US dollars. If we converted Canadian dollars to USD to bring this balance back up to zero, because we bought those US dollars, we're now exposed to the currency exchange rate between Canadian dollars and USD. So if we ever intend to sell those USD and get Canadian again, for whatever reason, we may have to do it at a less favorable price. And you may exchange at a more favorable price if it worked in your favor. So because I'm long a certain portion of Canadian and I'm short a certain portion of USD, there is some currency risk associated with these positions here. There's always currency risk. The conclusion of this video is that there's always going to be currency risk, no matter if you're using currency adjusted products or if you're adjusting the currency risk yourself and handling it yourself. In the next video, I strongly think you guys should watch it. I'm gonna go over how to handle currency risk for different types of investors. Let's say you're in Europe or in the UK or in Canada or in New Zealand and you want to invest in these foreign markets. You can buy the shares, but then how do you handle the currency risk? Check out this playlist I have of tutorials about the interactive broker software. If you guys want to learn about some of the tools that I write for traders in Sierra Chart, check out this playlist right here. I'll see you in the next video. Cheers.